Forget the talking heads on TV. Today, we're cracking open a top strategist's private brief to understand what really moved the market. They're saying the market didn't just rally, it dodged a bullet. And we're going to break down the one number that mattered more than all the noise and what it means for the future of AI. So let's get right into it.
Okay, so this is how the strategist summed up the entire day. Sounds a little cryptic, right? A breeze from Japan, a spark from Oracle. I mean, what do those two things even have in common? Well, on the surface, nothing. But this report argues they were two sides of the same coin, and they worked together to fight back against this wave of tech pessimism. The real question is, how'd they pull it off?
To solve that puzzle, you got to follow the clues. And today, there were 5 big ones that mattered. We've got a political power play in Japan, a really shocking signal from the bond market, and a bluff from China that, frankly, the smart money just completely ignored. Let's connect the dots. All right, first up, let's talk macro, specifically the bond market. Because today was a classic showdown between a loud, headline-grabbing threat and a quiet but incredibly powerful vote of confidence.
And here is that battle, laid out plain and simple. On the left, you've got the noise. It's China, once again, hinting that its banks should maybe sell some of their U.S. treasuries. Look, the market's heard this story 100 times. It's the same old song and dance. But on the right, you have the real signal. Alphabet, Google's parent company, went to issue some corporate bonds, and an absolutely staggering $100 billion in orders came flooding in.
I want you to just let this number sink in for a minute. $100 billion. This is not meme stock money. This is the smart money. We're talking about huge pension funds, giant insurance companies. These are the global institutions that don't make bets they aren't absolutely sure about. And with this one move, they are all screaming the same thing. We believe in the long-term cash flow of building out AI. That, my friends, is the real story. And here's the proof in the pudding. Despite all of China's huffing and puffing, the 10-year Treasury yield, which is a key benchmark for the entire market, it actually fell. The market heard the noise and it heard the signal, and it decided to follow the real money. It chose to follow the $100 billion. So we've seen the big picture, this massive vote of confidence in the market. Now let's follow the money. Where did all that confidence actually flow? Let's drill down and look at the winners and losers at the sector level. It was really a tale of two very different markets today. On one side, you had technology. The big players saw last week's dip as a golden buying opportunity for AI leaders, and they pounced. On the other side, you had healthcare, which just got hammered by a mix of some bad company-specific news and investors deciding to take some profits off the table. Let's break down exactly why. Let's zoom in on the day's leader, Oracle. It surged almost 10%. Now, this wasn't just some vague optimism. The catalyst was directly tied to reports that OpenAI is about to secure a massive new round of funding. So why does that matter to a company like Oracle? Well, it answers the biggest question investors had. Can these AI giants actually afford to pay their gigantic cloud computing bills? And the market's answer today was a resounding yes. It completely erased the fear that Oracle's customers wouldn't be able to pay up. And for the complete contrast, look at hims and hers. It collapsed 16%. This wasn't just a bad day. The strategist in the report calls this a structural break. The company said it would stop selling its generic weight loss drug after getting hit with legal threats and more scrutiny from the FDA. This is a perfect, painful example of what happens when a risk that was once just a what-if suddenly becomes a reality.
The revival of stocks like Oracle directly punched a hole in last week's biggest fear, the so-called SaaS apocalypse. Remember that? This was the idea that powerful new AI would just make existing software companies obsolete. But today's action, led by giants like Oracle and Microsoft, proved that these big, established players are actually the critical plumbing for the whole AI infrastructure. The fear, it seems, was massively overblown.
Okay, so we've analyzed what happened and we've analyzed why. But now for the most important part. How do you position yourself for what comes next? This is all about having a game plan instead of just reacting to the headlines.
All right, so here's the playbook, plain and simple. If you're bullish, the trigger you're watching for is a close in the S&P 500 above 7,000, and you need to see it happen with real, convincing volume. That's a huge psychological level. If that happens, the strategist says it's time to start buying the dip in software and semiconductor equipment. But if you're more cautious, you're watching the 10-year Treasury. If that yield spikes up over 4.3%, that is a major red flag. That's your signal to trim some tech and move into safer spots like cash and gold. It's about having clear triggers for your actions. So we've covered the macro signals, we've looked at the sector rotation, and we have a strategic playbook. Let's bring it all together for the final verdict and look ahead to the next critical test for this market rebound.
After a day like today with so many moving pieces, it's really easy to get lost in the noise. So the crucial question is this: what is the one single piece of data that's going to tell us if today's rebound is for real?
It all comes down to the December retail sales report. Now, why this number? Because it is the ultimate reality check on the health of the American consumer. If sales are strong, it backs up that whole soft landing story that the market wants to believe in so badly. You know, the idea that the economy can cool down without crashing into a recession. A strong consumer gives this entire market a solid foundation to stand on.
And that brings us to the final piece of wisdom from this report. This is a principle that can guide you through all the chaos. The market pretends to react to news and headlines. It loves the drama. But in the end, it always comes back to two things: liquidity, the actual flow of money, and earnings. Today was the perfect case study. China's threats, that was the news. The $100 billion for Alphabet's bonds, that was the liquidity. And the market just showed you, in no uncertain terms, which one it truly trusts.